Hello everyone, my name is Lamarr Baxter, Senior Loan Officer with All Western Mortgage. Today's topic we're going to be covering, in particular for real estate professionals, be whether real estate agent and or broker, is to basically make sure that you're not losing deals as a result of down payments as well as closing costs. There's a lot of different options that's available to your clients as it relates to coming up with the down payment and or closing costs outside of down payment assistance programs. For the last 8 years, and I'm still currently in the industry, I've been actually working with clients opening up retirement accounts, in particular self-directed retirement plans. So there's a lot of information that's available to your consumer, or should I say your client, that they have access to some retirement funds to be able to take care of down payment and closing costs. Not to mention it's a better option than using credit cards, and there's some caveats to basically accessing those funds that a lot of people are not aware of it, but it also depends on the plan agreement. So one of the things I want to talk about in particular is being able to access funds, whether it be from a retirement plan, whether it be a 401k or an IRA. So we'll start off with the 401k. Usually with the 401k, what we call an employer sponsored plan, usually you have access to your funds in three manners. Number one would be accessing the funds via an in-service withdrawal, which basically usually allow you to access up to a certain percentage of the vested funds from the retirement account to allow you to move it to another retirement plan. It's not a distribution where it's taxed and penalized, but it's an actual method of moving funds from that existing plan where you're still employed over to another retirement plan, usually a self-directed plan, and being able to access the funds and use different strategies to access those funds. The second option would be a loan, an actual employer-sponsored plan loan or a 401k loan, where you're usually allowed to borrow up to $50,000 and you have up to 5 years to pay back the funds. One of the nice things is a lot of people have the illusion that usually if you're borrowing from your 401k, whatever interest rate you're paying is usually paying to a bank. In essence, you're actually paying whatever the interest rate will be. Usually it's in around 2 to 3%, but it usually is based on a certain margin plus prime, to where you're actually paying the interest rate back to your retirement plan. So in essence, you're actually borrowing from your retirement plan, not from a bank or any other financial institution. Once again, you can access up to $50,000 and you have 5 years to pay it back. So definitely, if you have a client who have retirement plans, to make sure as you're basically sitting down with them and you're asking questions about down payment and closing costs, make sure you ask the question as to what type of funds they have access to when it comes to retirement plans. Now the other option, once again talking about 401k or any employer-sponsored plan, is you have access to a hardship withdrawal. And what that means is that you can access those funds. This is outside of the loan, where you're actually taking a distribution where you're going to be taxed on the amount that you're taking out. But usually if the withdrawal is considered a hardship and it's an approved hardship by your plan administrator, you can usually access those funds without the 10% distribution penalty if you're under the age of 59 and a half. So once again, make sure you're looking at those options that's available to you when it comes to the employer-sponsored plan or the 401k. Now, if your client has an IRA, an individual retirement account, whether it be a SEP IRA, a traditional IRA, or Roth IRA, there's another set of strategies that's available to you to be able to access those funds. So usually, say your client's account with this, say with a Charles Schwab or some other name custodian, they can actually transfer those funds from that custodian over to a self-directed plan, a retirement plan. Through a self-directed retirement plan, you're able to access those funds or direct those funds for an investment in the form of a loan. So this is usually where if a client, a friend or a relative who's not a disqualified person, and we can talk about that in more detail if you have questions offline, is where you're actually able to loan money out of your retirement account, whether it be secured by real estate or any other means such as equipment, or you can actually do an unsecured loan. So use a scenario where a friend or a relative is actually loaning money, say $7,000 to cover closing costs. What would happen is that self-directed plan will be a promissory note drawn up where the self-directed retirement plan will become the lender. That lender will actually loan money to a person who's not a disqualified person, and whatever the terms may be is usually up to the account holder who will set the terms. That money can be loaned out for any period of time, and those terms once again are subject to whatever the account holder feels is deemed as a good return for their retirement plan. So once again, there's an option using retirement plan funds to be able to access money for both down payment and closing costs. So keep in mind, if you're working with someone who's trying to obtain a home or purchase a home, whether it be a VA or FHA, and there may be some closing costs and or down payments funds required, those are options that's available to you to be able to access those funds. Because once again, we may have situations to where you have a client who wants to purchase a property and they don't have access to or may be eligible for a down payment assistance program. The other option is to look at the retirement funds. So if you have any questions, my name is once again is Lamarr Baxter with All Western Mortgage. Feel free to give me a call at area code 916-237-7310 or email me at lbaxter@allwestern.com. Thank you.
It's your mortgage made easy. Make your next mortgage an